Coronavirus concerns have swept through financial markets. Globally, stocks have endured some of their worst performances since the days of the financial crisis. For instance, the U.S. stock market, as measured by the S&P 500, fell 7.6% in one day on the 9th of March 2020, its joint fifth worst trading day since 1988. On the same day, UK stocks, as measured by the FTSE All-Share Index, fell sharply. It dropped 7.4%. What next? It is impossible to predict what may happen next. The severity of the disease and its long-term economic impacts are still yet to be seen. However, while the stock market has been quick to react, history shows it has a tendency to bounce back strongly over time. Keep up to date with the latest on how coronavirus might impact investments and the economy here.How the stock market bounces back. Using the US stock market as an example, the past 3 decades show the strongest 5-year rebound in the US brought a return of 164%. This is an annualized return of 21% in the 5 years after a 6.7% fall for the S&P on the 20th of November 2008. That date was during a particularly gloomy phase of the 2008-09 financial crisis. Given the abject mood at the time, investors may have struggled to believe that an investment of $10,000 made in the market at the start of that turbulent day would have grown to $26,400 within 5 years, before charges. Of course, past performance is not guaranteed to be repeated in the future. The returns are illustrative and do not include any costs or fees. But the data underlines the historic resilience of shares over longer time frames, even following shocks. The US stock market's 10 worst days and their rebounds. A short history of the stock market's worst days. As the table above shows, the pattern is repeated on many other of the 10 worst one-day crashes. Falls associated with the global financial crisis, including the Eurozone debt crisis, account for 7 of the 10 worst days the US stock market has endured since 1989. The most severe was a 9.0% fall on the 15th of October 2008. This was followed by a 5-year return of 109%, or an annual equivalent of 15.9%. The credit crisis escalated into a full-blown financial crisis in 2008 with the collapse of the investment bank Bear Stearns, and worsened with the failure of Lehman Brothers in September of that year. This created a domino effect among banks and insurers. Forced mergers and government bailouts were required to stabilize markets. Such crisis moments attract contrarian investors, such as the fated investor Warren Buffett, who invested $5 billion in Goldman Sachs in September 2008. And the worst of the rest, the stock market falls during the post-dot-com 2000 to 2003 slump did not make the top 10. A 5.8% fall on the 14th of April 2000 was the 12th worst. It was followed by a 7.4% loss 5 years later. The data doesn't stretch back to Black Monday in October 1987 when US stocks fell 22% in a day. Therefore, more on this story, visit the news article link.